Disclaimer.
Today is Friday the 13th, and if you're watching this, you probably already know that just 2 weeks ago we witnessed the biggest precious metals crash since 1980. $7 trillion in market value vanished in a single session. Silver plummeted 35%. Gold fell off a cliff. But here's what should grab your attention right now. Yesterday, February 12th, it happened again. In less than 30 minutes, silver was slammed from $85 down to $75. Gold slid back below the $5,000 mark as if someone pulled the plug. The mainstream financial media has their explanations ready. Strong jobs data. Iran negotiations. A healthy correction. You've heard this before. Every time that precious metals get too close to a true breakout, something conveniently happens to knock them back down. What if I told you that these two crashes in 14 days aren't random? While you're being told to stay calm, the US government just launched Project Vault, a $12 billion emergency stockpile. Why is the Treasury panic buying silver at $75 while telling you the rally is over? The pattern we're seeing is exactly the same playbook that's been used for decades to transfer wealth from everyday investors to the institutions that control these markets. Today, I'm showing you the data they don't want you to see. January 30th started like any ordinary trading day. Gold was touching $5,600 an ounce, a price that would have seemed unthinkable just 3 years earlier. Silver had broken through $120 for the first time in history, shattering records that had stood for over 4 decades. Central banks around the world were scrambling to buy physical metal faster than refineries could produce it. The momentum felt unstoppable, and for good reason. Every fundamental indicator pointed toward higher prices. Then the headlines hit. Kevin Warsh, nominated for a key Federal Reserve position, made comments suggesting a stronger dollar policy ahead. Within hours, the selling cascade began. Not gradual profit-taking that you'd expect in a healthy market. A waterfall. $7 trillion in market value erased before most Americans even finished their morning coffee. Silver dropped 35% in what should have been mathematically impossible for a physical commodity with genuine industrial demand and documented supply shortages. Think about that for a moment. Silver is used in solar panels, electric vehicles, smartphones, medical equipment, military applications, and thousands of industrial processes that literally cannot function without it. Our government classified silver as a critical mineral last year, specifically because we don't have enough of it and can't easily substitute alternatives. The supply deficit has been widening for 6 consecutive years. And somehow, in a single trading session, the market decided this essential commodity was worth 35% less than the day before. Does that make sense to you? Pop quiz. When was the last time you saw oil drop 35% in one day without a major war ending or a pandemic lockdown lifting? It doesn't happen. Commodities with real-world industrial applications don't move like that unless something else is going on behind the scenes. But here's where the story gets genuinely interesting, and where most people stop paying attention right when they should lean in. After the January crash, something entirely predictable happened. The dip buyers came in. Investors who understood the fundamentals, the supply deficits, the central bank accumulation, the industrial demand growth, recognized what looked like an obvious opportunity. Silver recovered. It climbed back up toward $85 over the following days as the initial panic subsided and rational analysis returned to the market. Gold stabilized above $5,000 and started creeping higher again. The narrative shifted back to the structural reasons these metals were rising in the first place. Retail investors who had been scared out of their positions started cautiously buying back in. The fear from January had faded just enough for regular people to feel confident again. Money started flowing back into precious metals funds. The charts looked constructive. Everything pointed toward a resumption of the bull market that fundamentals demanded. And then, boom, February 12th, another crash. Different headlines this time. Iran nuclear negotiations showing unexpected positive signs. A stronger than expected jobs report pushing the dollar higher against foreign currencies. In less than 30 minutes, silver drops from 85 to 75. Gold falls back below 5,000 like someone flipped a switch. 2 random crashes in 2 weeks. 2 separate news events that just happened to produce identical results. Or a systematic campaign designed to shake retail investors out of their positions before the next major leg higher. Have you ever watched someone play a slot machine in a casino? The house doesn't need to cheat on every single spin. They just need the mathematical odds tilted slightly in their favor over thousands of pulls. The player wins enough to stay excited, keeps feeding coins into the machine, and slowly, methodically, the house extracts wealth from the player's pocket while making them feel like they almost won. What we witnessed in January and February looks remarkably similar, just operating at a much larger scale with much higher stakes. Let prices run up until retail investors get excited and start buying. Let them establish positions near the highs when enthusiasm peaks. Crash prices suddenly and violently on convenient news hooks. Watch the panic selling cascade as stop losses trigger and margin calls force liquidations. Scoop up the physical metal at deeply discounted prices while everyone else runs for the exits. Let prices recover gradually until retail gets excited again. Repeat the cycle. This isn't conspiracy theory. It's a documented business model with a paper trail. In 2020, JPMorgan Chase paid $920 million in fines and penalties to settle federal charges of systematically manipulating precious metals markets over a period of years. Not accused, they paid. They admitted to a pattern of spoofing and manipulation that cheated other market participants out of fair prices. And that's just one institution that happened to get caught and prosecuted. Now consider the timing of yesterday's crash and what's happening today. It's not random that we're sitting here on Friday the 13th with gold below $5,000 and silver at $75. Today, the Bureau of Labor Statistics releases the Consumer Price Index, our monthly inflation reading that moves markets more than almost any other data point. Every algorithmic trading system on Wall Street is poised and ready to react in milliseconds to whatever number comes out. If CPI comes in hotter than expected, suggesting inflation remains stubbornly elevated, the dollar might weaken and metals could rally hard as investors seek inflation protection. If CPI comes in cooler than forecast, we might see another leg down as dollar bulls pile in and push precious metals lower. Either way, volatility is absolutely guaranteed today, and volatility serves a very specific purpose for institutions, with the capital, technology, and speed to trade it profitably. For regular investors like us, people with jobs, families, and retirement accounts to protect, volatility feels like chaos and uncertainty. We're told to stay calm, think long-term, and not react emotionally. Good advice in normal circumstances. But for the institutions moving billions of dollars with algorithms that execute trades in microseconds, volatility is pure opportunity. Specifically, it's the opportunity to separate retail investors from their positions at exactly the worst possible moment, buying real assets at panic prices that don't reflect underlying value. Here's what concerns me most about the pattern we're witnessing unfold. The crashes keep coming at precisely the moments when regular Americans start paying attention to precious metals as a legitimate investment. When gold crosses psychologically significant round numbers like $5,000, when silver makes headlines for breaking multi-decade records, when the narrative among everyday people starts shifting toward metals as a safe haven from inflation and currency debasement, that's exactly when the hammer comes down. Think carefully about who benefits from that specific pattern. Not the retiree trying to protect their life savings from the inflation that's already eroded 20% of their purchasing power. Not the young family attempting to build generational wealth outside a financial system that seems increasingly unstable. Not the small business owner hedging against dollar weakness that threatens their supply chain costs. The beneficiaries are the same entities that have the capital to buy aggressively after scaring everyone else out of the market. The same institutions that pay $100 million fines as simply a cost of doing business, a rounding error on their trading profits. The same players who publicly tell their wealthy private banking clients to accumulate gold while their trading desks profit from crashes that devastate retail positions. The question we need to answer isn't whether these crashes were manufactured. The circumstantial evidence speaks loudly for anyone willing to listen. Gold touched $5,600. Silver broke $120. Central banks worldwide were buying faster than mining production could keep up with demand. Physical premiums were spiking at coin dealers across America. Something had to be done to cool the market. Or more accurately, something had to be made to give. The real question is why this is happening now, and why the same playbook executed twice in just 2 weeks. What you're about to learn explains exactly who benefits from keeping everyday Americans out of precious metals at the precise moment when the institutions themselves are loading up for what comes next. Because here's the uncomfortable truth that mainstream financial media will never tell you directly. The crashes didn't change a single fundamental reason why gold and silver were rising in the first place. Not one. Our national debt didn't shrink. It just crossed $38 trillion. Central banks didn't stop buying. They're on pace for another 750 tons this year. The silver supply deficit didn't suddenly reverse. It's entering its 6th consecutive year. The dollar's purchasing power didn't magically recover. Your grocery bill proves that every week. The only thing that changed on January 30th, and again on February 12th, was who owns the metal, and that should tell you everything you need to know about what comes next. Let's examine what actually happened in January and February, because when you line up the evidence, the pattern becomes impossible to ignore. January 30th. The trigger was Kevin Warsh's nomination to succeed Jerome Powell at the Federal Reserve. Headlines screamed about a stronger dollar policy ahead. Gold dropped from $5,600 to around $4,400, a stunning 21% correction. Silver suffered even worse, plunging from 120 to the mid-80s in what Bloomberg called its worst single-day decline since the Hunt brothers collapse in 1980. Then came February 12th. Different headline, identical result. Iran nuclear negotiations showed positive signs. The jobs report came in stronger than expected. The dollar index firmed up. Silver crashed again, this time from around 85 down to 75 in less than 30 minutes. Gold slid back below 5,000. 2 crashes, 2 weeks, 2 different news hooks, 1 identical outcome. Retail investors shaken out of their positions at exactly the wrong moment. But here's what the mainstream coverage conveniently omits. According to the World Gold Council's latest data, central banks purchased over 860 tons of gold in 2025, and surveys show 95% of central banks expect to increase their gold reserves through 2026. JPMorgan projects approximately 755 tons of official sector purchases this year, well above the pre-2022 average of 400 to 500 tons. Think about that for a moment. While retail investors were being told to sell into panic, the world's monetary authorities were quietly accumulating at the fastest pace in decades. Poland's central bank added 102 tons in 2025 alone, bringing their total reserves to 550 tons. In January, Governor Adam Glipinski publicly stated his intention to increase reserves further to 700 tons, and I quote, "for national security reasons, not investment returns, not inflation hedging, national security." Kazakhstan added 57 tons last year, their highest level of annual buying since 1993. Governor Timur Suleimanov stated plainly that they want to stay a net gold buyer until global tensions ease. Brazil's central bank re-entered the gold market after a 4-year absence, adding 43 tons between September and November. These aren't speculative hedge funds chasing momentum. These are sovereign monetary authorities making strategic decisions about how to protect their nation's wealth. And they're not selling into crashes. They're buying through them. Now let's talk about silver, because the story here is even more dramatic. According to the Silver Institute's latest projections, the silver market is entering its 6th consecutive year of structural supply deficit in 2026. The projected shortfall this year is approximately 67 million ounces, following a staggering 117 million ounce deficit in 2025. When you add up the cumulative shortfall from 2021 through 2025, you get approximately 800 to 900 million ounces. Nearly an entire year of global mining production that simply doesn't exist. Those missing ounces have been drained from exchange warehouses, bank vaults, and above-ground inventories worldwide. COMEX registered silver inventory, the metal immediately eligible for delivery, has shrunk by roughly 75% since 2020, currently hovering around 82 million ounces. Shanghai's vault inventory has fallen to its lowest level since 2016. The physical shortage isn't theoretical, it's measurable, and it doesn't disappear because the paper price crashes. But the supply situation got dramatically worse on January 1st of this year. China implemented new silver export restrictions that transformed the global market overnight. The new licensing framework requires exporters to obtain government approval, and only 44 large state-approved entities, each with annual production above 80 tons and substantial financial reserves, are now permitted to ship silver abroad. This policy effectively restricts 60 to 70% of global refined silver supply to domestic Chinese use. Elon Musk himself responded to the announcement on X, stating simply, "This is not good. Silver is needed in many industrial processes." China didn't make this move because silver is abundant. They made it because silver is scarce, and they understand its strategic importance for solar panels, electric vehicles, AI infrastructure, and advanced electronics better than most Western policymakers do. Meanwhile, our own government quietly added silver to the critical minerals list in late 2025, acknowledging its essential role in electrical circuits, batteries, solar cells, and medical instruments. The United States launched Project Vault, a $12 billion emergency stockpile initiative to secure domestic supplies of critical minerals, including silver. Ask yourself, why would the Treasury be panic buying silver at $75 while telling you the rally is over? The actions don't match the narrative. Now let's look at what the institutions betting real money are actually saying, not in press releases designed to move markets, but in their research notes to clients with billions on the line. JPMorgan raised their year-end 2026 gold target to $6,300 per ounce in a note published just after the January crash. Their analysts, Gregory Shearer, Jason Hunter, Ali Ibrahim, and Ananyashri Gupta, wrote that gold remains a dynamic, multifaceted portfolio hedge, and investor demand has continued to come in stronger than our previous expectations. $6,300. That's a 30% gain from current prices, around $5,000. They're not panicking. They're projecting significant upside. JPMorgan Private Bank is even more aggressive, forecasting $6,500 gold. Bank of America raised their 2026 outlook to $5,000 gold and $65 silver, though their research suggests silver could reach anywhere from $135 to $309 under certain scenarios. For silver specifically, Citigroup revised their forecast higher in January, expecting silver to reach $150 per ounce within 3 months. They called silver gold on steroids and pointed to continued strong buying momentum in China as the primary driver. Goldman Sachs expects silver to average $85 to $100 per ounce in 2026, viewing it as the primary strategic metal of the green energy transition. These aren't fringe forecasters or YouTube personalities. These are the largest financial institutions on the planet, the same ones that actually move markets, telling their wealthy clients to accumulate precious metals, while the financial media tells retail investors to sell. The pattern recognition here is crucial, and history provides the roadmap. Every major precious metals crash in the past 50 years has been followed by higher highs. The 1976 correction, when gold dropped from $197 to $103, preceded the 1980 mania that took gold to $850. The 2008 crash preceded the 2011 peak. The 2013 takedown preceded the 2020-2026 supercycle we're living through right now. The playbook is identical every time. Crash prices suddenly and violently, shake out weak hands through fear and margin calls, accumulate physical metal at discounted prices from forced sellers, then let the underlying fundamentals reassert themselves. January 30th was Act 1 of this cycle's shakeout. February 12th was Act 2. The question isn't whether there will be an Act 3. There will be. The question is whether you'll recognize it for what it is before the next leg higher begins. Consider the institutional behavior we can actually observe. The CME Group raised margin requirements following the steep January sell-off. Margins on COMEX, gold futures went from 6% to 8%, while silver futures margins jumped from 11% to 15%. Higher margins force leverage traders to either post more capital or liquidate positions. Guess what most retail traders do when faced with that choice during a panic? Goldman Sachs analyzed the mechanics in a note published after the crash. As prices fell, dealer hedging flipped from buying into strength to selling into weakness. Investor stop-outs were triggered and losses cascaded through the system. The crash wasn't driven by a sudden collapse in physical demand. It was a paper market unwind, amplified by policy shifts, dollar strength, and technical triggers designed to force liquidations. Meanwhile, gold has now overtaken the euro as the world's second-largest reserve asset. That's not a temporary fluctuation. It's a structural shift in how the global monetary system views gold's role. Central banks aren't treating these crashes as signals to reduce exposure. They're treating them as buying opportunities, just as they have consistently since 2022. The disconnect between what institutions are doing and what retail investors are being told should concern anyone paying attention. When JPMorgan says $6,300 gold and the price drops to $5,000, that's not a contradiction, that's an invitation. When 95% of central banks plan to buy more gold and retail investors are told this is the top, that's not analysis, that's misdirection. Remember that JPMorgan paid $920 million in fines for precious metals manipulation. They admitted to systematically spoofing the market over a period of years. That's not ancient history. That settlement was in 2020. The same institution, now projecting $6,300 gold. The same institution whose trading desks have the capital, the algorithms, and the market, access to profit from exactly the kind of volatility we witnessed in January and February. The fundamentals haven't changed. The deficits haven't reversed. The central bank buying hasn't stopped. Our national debt just crossed $38.5 trillion and is adding over $8 billion per day. The Federal Reserve is trapped between fighting inflation and avoiding recession. The dollar's purchasing power continues to erode. Your grocery bill proves that every week. What changed on January 30th and February 12th wasn't the fundamental case for precious metals. What changed was who owns the metal, and understanding that distinction is the difference between being a victim of volatility and being positioned alongside the institutions that create it. Right now, as you're watching this on Friday the 13th, gold is trading around $4,900 per ounce. Silver sits at approximately $77.50. Just this morning, the Bureau of Labor Statistics released the January Consumer Price Index, our monthly inflation reading, and the numbers came in softer than expected. Annual inflation slowed to 2.4%, below the 2.5% forecast. Monthly CPI rose just 0.2%, under the expected 0.3%. Core inflation, excluding food and energy, came in at 2.5%, the lowest reading since March 2021. What does this mean for precious metals? In the short term, cooler inflation data strengthens the case for Federal Reserve rate cuts, potentially as early as March. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold and silver. The setup for precious metals just improved, even as most retail investors remain fixated on the recent crashes. Now let's do the math that actually matters. The math that separates informed investors from those who get shaken out at the worst possible moment. Gold at $4,900 today versus JPMorgan's year-end target of $6,300 represents approximately 29% upside potential. Their private bank is even more aggressive at $6,500. That's 33% above current prices. Bank of America's $5,000 target suggests we're essentially at fair value with room to run. But here's where it gets interesting. These aren't speculative price targets based on technical analysis or wishful thinking. They're derived from quantifiable demand projections. JPMorgan forecasts approximately 585 tons of total quarterly demand flows in 2026, breaking down to 190 tons from central banks, 330 tons from physical investment demand, and 275 tons from ETFs and futures combined. Against annual global mining production of approximately 3,600 to 3,700 tons, this institutional appetite creates structural supply constraints that don't resolve quickly. Mining companies face increased production costs and longer development timelines. You can't simply flip a switch and produce more gold when prices rise. The supply response takes years, not months. Silver's mathematics are even more compelling and more urgent. At $77 today versus Citigroup's $150 target, you're looking at nearly 95% potential upside. Goldman Sachs expects silver to average $85 to $100 through 2026. Bank of America's research suggests silver could reach anywhere from $135 to $309 under certain scenarios. Yes, you heard that correctly, $309 per ounce. Even the conservative estimates from JPMorgan, projecting $75 to $85, suggest current prices represent a floor, not a ceiling. TD Securities has an average annual target of $65.50 with a high of $118. These institutions aren't projecting crashes from current levels. They're projecting substantial upside. Why is the institutional consensus so bullish despite the recent volatility? Because they understand something that retail investors often miss. Supply deficits don't disappear because paper prices crash. The Silver Institute projects the 2026 deficit at approximately 67 million ounces. The cumulative shortfall from 2021 through 2025 totals roughly 800 to 900 million ounces. That's nearly an entire year of global mining production that simply doesn't exist in available inventory. You can't manufacture physical silver out of thin air, and you certainly can't do it by selling paper contracts. Meanwhile, industrial demand keeps growing regardless of price. Solar panel manufacturing alone now consumes over 200 million ounces annually, and that figure is projected to more than double by 2030 as the world accelerates its energy transition. Electric vehicles use twice as much silver as gas-powered cars, about 1.3 ounces each. Tens of millions of EVs hitting roads in the coming years will continue to spike demand. Add in 5G infrastructure, AI hardware, medical equipment, and electronics manufacturing, and you have a demand profile that remains robust regardless of what happens in the paper futures market. Industrial consumers don't stop buying silver because the COMEX price drops. They often accelerate purchases to lock in lower prices while they can. This brings us to the critical question. Everyone watching this video is asking, is this the criminal discount of the decade, or is this the top? Let's examine what would need to be true for current prices to represent a top. Central banks would need to stop buying gold. The data says they're not 95% expect to increase reserves through 2026, with projected purchases around 755 to 800 tons. Poland is targeting 700 tons for national security reasons. Kazakhstan wants to stay a net buyer until global tensions ease. Brazil re-entered the market after 4 years away. The silver deficit would need to reverse. This is the 6th consecutive year of structural shortfall. And China's export restrictions, effective January 1st, have tightened supply further by restricting 60 to 70% of global refined silver to domestic use. The dollar would need to strengthen dramatically on a sustained basis. The Federal Reserve just got inflation data supporting potential rate cuts. Our national debt just crossed $38.5 trillion. Interest payments alone are on track to exceed $1 trillion annually for 2026. The structural case for dollar weakness hasn't changed. Industrial demand would need to collapse. Solar installations are accelerating globally. EV adoption continues despite economic headwinds. AI infrastructure requires enormous quantities of silver for its superior conductivity. None of these trends are reversing. For current prices to represent a top, virtually every fundamental driver would need to shift simultaneously in the bearish direction. That's not what the data shows. That's not what central bank behavior indicates. That's not what institutional research projects. What the data actually shows is a manufactured buying opportunity. the same pattern that has preceded every major leg higher in precious metals for the past 50 years. Now let's talk about what happens next, because the timing here matters. Today's CPI data came in cooler than expected. That's bullish for metals because it increases the probability of Fed rate cuts. Lower rates reduce the opportunity cost of holding gold and silver versus interest-bearing assets. If you're an institutional investor choosing between treasury bonds at 3.5% and gold with no yield, lower bond rates make gold more attractive on a relative basis. But here's the key insight most people miss. Precious metals don't need falling rates to rise. They need uncertainty. They need fiscal instability. They need confidence in fiat currencies to erode. All of those conditions remain firmly in place regardless of what the Fed does in March. The Congressional Budget Office just projected the federal deficit will reach $1.9 trillion in fiscal year 2026, 5.8% of GDP. By 2036, that balloons to $3.1 trillion. Debt held by the public is forecast to rise from 99% of GDP at the end of 2025 to 120% by 2036. The CBO explicitly stated that our budget projections continue to indicate that the fiscal trajectory is not sustainable. This isn't partisan commentary. It's the official assessment of the nonpartisan Congressional Budget Office. The United States is on an unsustainable fiscal path, and that reality supports the long-term case for hard assets, regardless of short-term price volatility. Consider the critical moment we're in right now. Gold touched 5,600 just 2 weeks ago. Silver broke 120. Those prices will return. The question is whether you'll be positioned when they do, or whether you'll be watching from the sidelines after selling into the panic. The crashes of January 30th and February 12th didn't change a single fundamental. Central banks are still buying. The deficits are still widening. China's export restrictions are still in place. Industrial demand is still growing. Our national debt is still expanding at $8 billion per day. The Fed is still trapped between fighting inflation and supporting economic growth. What changed was positioning. What changed was who owns the metal. The weak hands got shaken out. The leveraged speculators got liquidated. The retail investors who bought at $120 silver panicked and sold at $75. And the institutions with the capital, patience, and conviction to buy the dip accumulated physical metal at prices they couldn't access 2 weeks earlier. This is exactly what JPMorgan's analysts mean when they project $6,300 gold by year-end, despite a crash, to $4,400 in between. They understand that volatility creates opportunity for those positioned to capitalize on it. They're not telling their wealthy private banking clients to sell into panic. They're telling them to accumulate. Here's what nobody in mainstream financial media will tell you directly. When JPMorgan says $6,300 gold and the price drops to $4,900, that's not a contradiction. That's an invitation. When 95% of central banks plan to buy more gold, and retail investors are told, this is the top. That's not analysis. That's misdirection. Friday the 13th, silver at $77.50, gold at $4,900. The CPI just came in soft, supporting the case for Fed rate cuts. Central banks continue accumulating at the fastest pace in decades. The silver deficit enters its 6th consecutive year. China has weaponized silver exports. Our government classified silver as a critical mineral and launched a $12 billion emergency stockpile. The institutions betting real money have already answered whether this is the top or an opportunity. The central banks adding hundreds of tons have already answered. The 900 million ounce cumulative deficit has already answered. The only question remaining is this. Will you recognize a manufactured buying opportunity for what it is? Or will you let the same players who paid $920 million in fines for market manipulation scare you out of the best performing asset class of the past 2 decades? The central banks have made their choice. JPMorgan has made their forecast. China has made their strategic move. The question isn't whether precious metals will reach new highs. The fundamentals guarantee it. The question is whether you'll be positioned alongside the institutions when they do or against them. Friday the 13th. Criminal discount or top? The data has answered. The institutions have answered. The central banks have answered. The only one who hasn't answered yet is you.